So what we're going to now look at in Learning Objective 2 is looking at how we account for uncollectible receivables. So we're going to look at the methods used to account for uncollectible receivables from Learning Objective 2 onwards. So unfortunately, uncollectible receivables are a normal part of many businesses' activities. There are unfortunately some customers that just don't pay, and there's a range of reasons for that. They go bankrupt, they choose not to pay, they have a disagreement with the business, they disappear, they die, they go to jail. There's a range of reasons why this can occur. And so as part of this, we need to have methods to account for these uncollectibles. And we refer to the uncollectible accounts as bad debt expenses. And they enter our income statement and therefore are a determinant of our degree of profit. So some of you might be wondering, well, if this is the case, why doesn't the business try harder to try and get the amounts they are owed back? Well, in some cases, they do try very hard. As I showed you before, some businesses will repossess products and resell those products in order to recover their money. But in any case, that is not always feasible, and it is not worth the effort required to recover that particular amount. So businesses therefore inevitably have some degree of bad debt expense. Now, one of the key reasons why we need to reflect the bad debt expenses in our income statement is they are an expense associated with generating revenue. So if a business offers their customers finance options, they can expect that they're going to generate higher amounts of revenue, and therefore, as a result, they're going to have more bad debt expenses. So as we've looked at a number of times, we need to match the expenses associated with generating revenues with those revenues. So if we offer easy credit and generate higher revenues, we need to try and match the bad debt expenses that are associated with that revenue and reflect that in our income statement. So an uncollectible account is written off and an expense is recognized. So when the expense is recognized associated with a bad debt depends on the method that we use to account for uncollectible accounts. And so today we're really going to be looking at a number of choices that businesses can use to account for bad debts. And the choice that is chosen will determine the profits that the business recognizes. So there are two methods to account for bad debt expenses that we're going to look at today. The first one is the direct write-off method. So basically the direct write-off method is where we write off and recognize the bad debt expense when we are absolutely certain that the customer is not going to pay us. So let me give you an example. Some of you might have watched a show called Outback Truckers, which is an Australian show about Outback truck drivers. And there was a guy on that show called Turbo, which is reflected in this article here. And there's a whole lot of information that they claim about Turbo here, including that he was owing a mechanic $10,000. He owed another business owner $20,000 for a truck he rented. And there are a whole lot of issues associated with Turbo's payment. And ultimately, Turbo was jailed for a number of years in Queensland over a number of crimes he committed, I believe, around fraud. And so accordingly, if Turbo owes you money but has no money to his name, is in jail, and therefore has really no way of paying you, then of course you're quite sure that you're never going to receive that money back. So if you apply all that information, you would write off the account. And so here we're applying the direct write-off method because we are now absolutely sure that that account that is owing from, say, Turbo will never, ever be paid. Now, it could take you some time to work out that the customer is not going to pay you. So if I go back to that article, it mentions in there that the mechanic that was owed $10,000 kept Turbo's truck for 2 years because the bill wasn't paid. And mechanics are allowed to do this according to the contracts that they have, that they will keep your vehicle if you don't pay the amount that is owing for the repairs that they have taken out on that vehicle. So they keep it as a form of security. Now, in any case, Turbo is unable to pay this amount, so therefore the business needs to directly write it off. Now, because it's taken them 2 years, say, to work out that they're never going to get their money, then of course in that particular case, there has been a significant time that's passed from when the revenue was originally recognized to when the bad debt expense has now been recognized associated with it. With the allowance method, what we do is we make an estimate of the degree of accounts that are on credit are not going to be paid. And we'll go through how we generate that estimate and the different ways of generating that estimate shortly. The question I have for you at this stage is, which principle does the direct write-off method violate? So please select what you believe to be the best answer now. So if we come back to the question that I just asked you, under the direct write-off method, the bad debt expense is recorded when the business determines the receivable is uncollectible and removes it from the records. Now, the example I just gave you, I mentioned Turbo, and we saw there that the mechanic was waiting 2 years for an amount that probably was never paid. So there was a break from the period the revenue was recognized to the bad debt expense being recognized in this case. And therefore, accordingly, what is happening is we are violating the matching principle. We have not related the bad debt expense with the revenues that was generated in that particular case. So the direct write-off method violates the matching principle and therefore is not permitted under generally accepted accounting principles, so GAAP for short. The only cases the direct write-off method is permitted is if the amounts that you are writing off directly and recognizing bad debt expenses for are an immaterial amount of the overall business's performance and net profit, essentially. So that means that they are not going to change anyone's perception of the overall success or otherwise of that entity by directly writing off those amounts, because they are so small, they're really insignificant in the grand scheme of the whole business. Now, how do you actually record a direct write-off if it is in fact an immaterial part of the overall business operations? Well, let's have a look at this particular example. It says, assume Emily makes a $4,000 credit sale to Jeff during March. In August, Emily determines that she will be unable to collect from Jeff. So Jeff goes bankrupt, disappears, whatever, and therefore never pays. So the original journal entry that was recorded here was to debit accounts receivable and credit the sales revenue. So there's nothing new there in that particular case. So what do we do when we discover that Jeff is never ever going to pay? This is the journal entry we record in this particular case. We debit the bad debt expense account, so therefore debiting expenses, we're increasing the expenses, and we credit the accounts receivable in recognition that we're never going to receive that accounts receivable. So essentially what we're doing by crediting accounts receivable is we are taking that asset out of our accounts and reducing our accounts receivable by the amount we expect not to collect. So as I mentioned, there are shortcomings of this method. Fails to match the expense with the revenue, which is why it's not acceptable under generally accepted accounting principles, or GAAP for short. It also provides the opportunity to manipulate earnings, which is a problem because that means that it's providing business managers, accountants, financial managers in the business the ability to determine what expenses they recognize and when. There is discretion here. You are making a judgment when you determine someone is not going to pay. They may pay in the future. They may not pay. How far do you go before you realize that someone is not going to pay what they owe you, and how long does that investigation process take you? The length of that time could be 6 months, it could be 5 years, dependent on the business's processes. So therefore, this provides the ability of businesses in some cases to opportunistically use this to write off amounts that are owing in one period, get those all out of the way, clear everything up that may not be paid, so therefore the performance might look better in a following period. And of course, that is manipulating the perception of the financial performance of the business, which is another reason why the direct write-off method is not permitted for amounts that are material. It also doesn't provide the best estimate of how accounts receivables affect cash flow that is expected in the future, because of course we don't have an estimate as to what proportion of the accounts receivable will not be collected at some point in the future. Now, as I've reminded you many times across this subject, it's really important that you keep up to date with your business knowledge. And if we turn to ABC Business's website today and we have a look at what's happening in the world of business, you can see there's a number of things here. Of course, many businesses have been greatly affected by what's happening with COVID-19. Some businesses have been crippled, particularly the tourist industry, because of course no one can really travel. We can't have any international tourists at the moment. So if we look at this in the context of today's topic, of course, some businesses are going to be realizing a lot of bad debt expenses because businesses and people they've dealt with will simply be unable to pay what is owed because they have no cash coming in. Their businesses are essentially closed. So of course, that is going to have a substantial effect on the bad debt expenses that they need to recognize, right? So as I mentioned across this course, make sure that you keep up to date with what's happening in the world of business, because it will make it easier for you to understand the concepts we're covering by relating it to the world that we're living in.